All right. Good morning. Good afternoon. Oh, it's already afternoon. Yeah. Good evening. So this will be a quick market review for today's trading. Today being the 24th of July, 2024. So first, starting from this will be short and direct and quick. So starting from the weekly time frame. We've been rallying higher. We've been rallying in a one-sided direction for the past few weeks, and the first week of July and the last week of July made these lows. These lows were clean lows. So below these lows here, we have sell side resting here. So below these lows, we have sell side. So we have sell side liquidity resting below these relative equal lows. And when price made this high here, the week of 15th of July took out the second week's high of July, and price dropped lower inside of this BC here. And when price dropped below this BC here, we had a rally up higher to make this weekly BC become an inversion fair value gap. So this is being seen as a weekly inversion fair value gap. So this is a weekly inversion fair value gap. You have that here. So going down to the 1 hour time frame. All right. Going down to the 1 hour time frame. As you can see, we have this here. I would like you to go to look at your Nasdaq, that is the US 100, to understand the correlation between these two markets, between the ES and the Nasdaq. How the Nasdaq failed to trade above this high here, while the ES here trades above this high. That is a cracking correlation. So when you have that cracking correlation, that is the market maker, that is the algorithm telling you that there's a significant move that is expected to unfold in the nearest future in price. So as we continue, as you can see, this sell side liquidity that was marked up from the weekly time frame, we have these relative equal lows resting below here, below this sell side liquidity here. So this is the relative equal lows. Let's make this slim and call this relative equal lows. So here we have these relative equal lows resting below here, which is the original consolidation. This right here is the market maker model, and we have not have a discussion on the market maker model, but we'll do that as we go into the mentorship, as we continue the mentorship. But as you can see, so when price dropped lower here, it left this order block. This is a bearish order block, and this right here, this is the first stage distribution after price dropped lower, leaving this breakaway gap. So we do not expect this breakaway gap to be filled because price dropped quickly lower. We had a quick expansion to a one-sided direction lower. So this means we are not expecting price for narrative to be in play. We are not expecting this breakaway gap to be filled. We already discussed breakaway gap in, I think, episode 14 or so. So this right here is the first stage distribution. So after this, price dropped lower and left this imbalance here, this fair value gap. This is a fair value gap. So when price dropped this fair value gap here. So here you have this fair value gap, which is the second stage distribution. This fair value gap is on the 1 hour. So, and viewing price action like this, it will give you a clear understanding to align yourself with higher time frame order flow, because higher time frame, from the higher time frame, we are interested in those relative equal lows there. That means because we are interested in the relative equal lows, being interested in lower prices for today's trading, it means every time the price, every rally higher, we see that as price going to a PDRA, a premium PDRA, to act as a resistance, to resist price from going higher. So after price dropped lower here, if you take your Fibonacci and measure from this, let's use the bodies, from this bodies high, the candles bodies high, to this candles bodies high, to this candles bodies low, price traded above equilibrium into a premium PDRA. This right here is a premium PDRA, and after trading to the premium PDRA, price dropped lower and traded down below this weekly inversion fair value gap. Because from the higher time frame, we are expecting that this fair value gap here to be an inversion fair value gap, to be inverted to target those relative equal lows resting below this, below here, to attack this relative equal lows resting below here, and the sell side, which is resting below this side here. So, and here, this right here is the previous weekly lows. So for liquidity pools, we expect we expect a significant portion of liquidity to be resting below key points, which are previous weekly lows, previous weekly highs, and previous sessions low and previous sessions high, previous monthly lows and highs, and previous daily low and highs. So here we have this previous weekly low. So the low for Friday's trading last week was this low, Friday the 19th of July. So it was this low. So when we had this low here, because it has already been established that price is already bearish and willing to go lower to trade for lower prices, that means we're expecting price to sweep those we are expecting price to be sweeping sell side liquidity to the downside. And in the Telegram group, I prompted you guys to note this, to study this model, this pattern. Yeah, this, the first stage distribution, the second stage distribution, and how to use this second stage distribution to facilitate intraday trading. So going into today's trading, because we have this pool of liquidity here and this pool of liquidity here resting below this place here, and we are expecting lower prices, and price has already been dropping lower. You, first and foremost, you take your Fibonacci and measure the low of this candle and the sell side liquidity, which is resting here. So you measure this pool of liquidities, this previous weekly lows and the relative equal lows resting below here. Now, why do we do that? To get a clear understanding of our draw on liquidity, because our draw on liquidity are these relative equal lows, but we do not need to wait for price to come to that relative equal lows to be profitable. So, and when you take your Fibonacci and when you measure the equilibrium of two liquidity pools, the equilibrium of those two liquidity pools is fair value. So we have fair value resting here below this place. So what I'm currently discussing now is I prompted the group to participate in this exercise live. So going down to the 5 minute time frame, Going down to the 5 minute time frame. So we had the midnight opening price here. So we had this midnight opening price here, and we have the 8:30 a.m. opening price here. Here is the 8:30 open. So when you have the London session failing to trade above the midnight opening price like this, when you have a price action like this, for the power of three video we made earlier, we noted that power of three for London, after a series of consolidation, price will trade above that recent consolidation that has been made. It will trade above the midnight opening price to manipulate price. This is where the Judas swing will take place, above the midnight opening price, and then price will draw down lower to distribute to the downside. This is for this is power of three. So when you have the London session failing to make this type of pattern, yeah, when you have the London session failing to manipulate higher above midnight session, this is price indicating to you that New York session and the trading intraday will be extremely one-sided. Does that make sense? So we had the power of three play out here on the New York session. So after the 8:30 opening price traded lower and consolidated and made this clean highs here. And then during the 9:30 trading, price traded higher and pushed out this buy side liquidity to manipulate price higher. From the power of three, you have the accumulation, the manipulation leg higher, and price distributing to the downside. Now, because that it's been established that price has made its power of three, its manipulation leg higher, meaning institutional order flow now will be bearish. Now, because institutional order flow is bearish, this is where your tape reading practices comes into play, comes into action now. So because it has been determined now that with this narrative in play earlier, it's been determined that institutional order flow is bearish. So when you have price purge out buy side liquidity like this and drop lower, price left this imbalance here, this fair value gap here, and we had price trade back inside of it at 9:45 a.m. Say you miss this first fair value gap here and price drop lower. Say you're trading the 10 a.m. to 11 a.m. silver bullet window. When price dropped lower like this, because it has already filled, it has already traded inside of a fair value gap like this and had this quick energetic move drop lower below below a previous pool of liquidity. This right here now is a breakaway gap. So we discussed the breakaway gap from I think episode 14 or episode 13 of this current mentorship. So we have this breakaway gap here. So here is the breakaway gap. And I prompted the group to note this breakaway gap from the 5 minute time frame. So here is the so here you have the breakaway gap. So this breakaway gap, when you have a breakaway gap like this, you don't expect price to trade back inside of this breakaway gap because institutional order flow has been determined to be bearish, and we already have price trade inside of this fair value gap here and drop lower. Now, because you do not expect this breakaway gap to be filled, say you're trading the 1 hour window from the 10 a.m. to the 11 a.m. window. Trading window, this trading window, the most times the 10 a.m. to the 11 a.m. window, this is when the second stage distribution generally occurs. So that is why it is called the silver bullet window, because that is when the second stage distribution, which you already have that first stage distribution already taking place in the marketplace, and you've identified the smart money reversal from the first move, which is the first turning point of a market maker model. So because you already have those criteria behind you, it has been solidified that price is trying to go lower already. So when you come to trade the 10 a.m. to 11 a.m. window, you already have the news, the all the high impact news, which typically occurs at 9:45 or 10 a.m. or 8:30 a.m. and probably in London's trading. All of those high impact news are already resting behind you. So you have little to no friction and little to no manipulation in price. You are trading a one-sided direction. This is why ICT pumps the most. This is why it made the silver bullet window, because it is a very simple trading model which relies on the second stage distribution of price to capitalize on that second stage distribution or a second stage reaccumulation. So back to it. So I prompted the group to note this 5 minute breakaway gap and label it as don't fill, because when you have a breakaway gap, you do not want that breakaway gap to be filled. Now, down to the 1 minute time frame. So in the 1 minute time frame, this is what you have here. From the higher time frame, I noted you to look for the equilibrium between the relative equal lows, which is this low here and this previous weekly low. This high here is the previous weekly low, and this low here is the previous. This is the relative equal lows from the higher time frame. Now, between the equilibrium between two liquidity pools is fair value. This is the liquidity pools I'm referencing. This previous weekly low and this relative equal lows down. Those are liquidity pools. When you have liquidity pools close to each other like that, you look for the equilibrium point of it to ascertain where is fair value. So the fair value is that. So that's why we have this red line here. So for the morning session, if you're trading this time window, this is your draw on liquidity. This is where you expect to take off your position, or at least your first partials. So going into the IPDA, because you already have from the 5 minute this breakaway gap, you do not expect it to be filled, and price valid here after creating this fair value gap. So you had price create this fair value gap here. So we had price creating this fair value gap here like this. So if you're changing the silver bullet window, this will be your entry, as you have price trades inside of it here, inside of this fair value gap, and you enter expecting lower prices. Now, what if you miss this? What if you miss this fair value gap entry model, this trade inside this fair value gap? What if you miss it? Do you allow the trade just go without you? Say price is here, it has not broken this low, it has not broken this swing low, price is already here at this black candle here, and you're expecting this to be reached. This is about from the fair value gap, from the low of the fair value gap to the midpoint of that liquidity pool is around 11.5 points, 11.5 handles. Do you allow price to go without you? You can. but you still have something to do. So for example, when you miss this fair value gap like this, before price trace before price trace through this low, before price trace to through this low, when you do not have a body close below this swing low, so you are not chasing price, you can still re-enter when price has not broken this low here with a clean body. When you have not had price trade below this low here, means you can still re-enter. How can you re-enter? You look generally before price comes to this low, before price breaks this low, after entering a fair value gap like this to trade lower, price will leave an order block, a bearish order block in this sense. So you look for the last up close candle, the recent up close candle before price is intending to come to this low. So you look for that up close candle. So when when the next candle is forming and price trace inside of that up close candle, you sell. You go into the market and click market order to sell. So this is when you'll be trading with market orders when you miss a fair value gap like this, because in this group we do not trade with market orders. You've been prompted from the beginning of the creation of that group that when you're trading, your entry, your stops, and your take profit should all be a static price level, should all be limit orders where while you are learning, especially when you are comfortable well enough to go into demo trading. So when you are demo trading, your orders, your entry models and everything should be on a limit order. But when you miss a fair value gap like this and price has not purged out, has not taken out this a recent swing low like this, you go into price looking for a up close candle. So when you have the next candle trade inside of that up close candle, you sell instantly. You click sell. So when you click sell instantly, you're expecting lower prices and your stops above this candle or below this breakaway gap, because you do not want price from the 5 minute time frame. This is a breakaway gap. That means you do not want price to trade up inside of it here. So your stops can be placed above this high here or above this or below this breakaway gap here, expecting lower prices. So we had price meandered around here and price dropped lower, and I prompted the group to note this low here. Let's take this away. Prompted the group to note this up close candle here at 10:05. So this candle you're prompted to note here is a bearish order block. So this right here is a bearish order block. So if you miss this candle here, this black candle, when it was trading inside of this bearish order block, if you miss this candle here, you wait for after price trace higher here with this order block here, you wait for the next candle to trade inside of it. So when the next candle is trading inside of this bearish order block, you click sell as a market order. Smart money traders sell up close candles. So when price was going higher, like for example these two up close candles, as price was rallying higher, smart money was inside clicking sell, 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 because when price was rallying higher here, price was offering higher prices for the uninformed. Price was offering higher prices to the uninformed. The algorithm is inducing buyers to come at the marketplace at higher prices to facilitate smart money sell entries, because smart money will never sell at a discount. They will never sell when price is low. They will always wait for the algorithm to take price higher so they can get a better value for their money. So that is why when price was going higher here, inducing buy entries, buy interest from the uninformed, smart money traders were entering using those buy interest as a counterparty for their sell orders. That what goes on inside of here, that is what goes on inside of this up close candle here, and also this up close candle here. That is why you were prompted to note this bearish order block. So and price did that here and traded lower. So we had all of this back and forth price action here, and price finally came to this low, this midpoint of this hour time frame pool of liquidity, the previous weekly low and the relative equal lows found on the weekly time frame. And we had price drop lower going into launch trading. So, and I think this was the business. Okay, so this was, how do I take this off? So this was the business for the morning session. So when this candle was trading higher inside of this order block, a sell position was taken around here. So a sell position was taken around here when price was trading inside of this bearish order block. This is the bearish order block that was used to enter. So you're not chasing price when price has not broken a previous swing low. Unless price has clearly broken a previous swing low, then you cannot enter into a trade if you miss the fair value gap. If you miss the retracement into the fair value gap, you cannot enter when price has broken that recent swing low. But if that swing low is still kept intact, price you have not seen a clear body close under it, then when price trades above it and enter inside of a fair value gap, sorry, of a order block, then you sell using the market order. So and your take profit at the equilibrium of those liquidity pools, because you do not have to wait for this relative equal lows to be tapped here. Let's take this off. So you don't have to wait for this relative equal lows to be tagged, so you can get off at the fair value of those liquidity pools. So that is it. I hope you got something from it, and if you did participate in this in today's live call out, then practice more. And if you didn't participate, you use this video as a walkthrough, as the to understand the inner thought of what was going on while we were practicing this tape reading session this morning, doing the morning session trading. So I hope you got something from this video. I'll talk to you very soon.